What's up, my real estate team? This is Norbert here to give you another mortgage rate update, letting you know what's happening with rates week ending March 15th, and more importantly, why rates did what they did. The conventional conforming 30-year fixed rate mortgage is sitting right at 7% as of Friday, March 15th, with buyers paying approximately 7/8 in discount points to get that rate. Government rates for FHA loans and VA loans price out approximately 3/8 to a half point lower than conventional rates. Of course, I'm basing this on a perfect scenario, which I describe as someone purchasing a single family home as their primary residence with a 760 or higher mid-FICO score and a down payment of at least 20%. Your specific situation may differ, so make sure you call a mortgage pro for the best breakdown for your specific scenario. So, what happened in the mortgage bond market and mortgage bond world this past week? Unfortunately, we lost some ground and mortgage rates got worse by approximately a quarter this week. We got a fresh slate of inflation data via the CPI and the PPI reports. Remember, higher inflation equals higher mortgage rates. Not good. This past Tuesday, we got the Consumer Price Index, or CPI report for February, which measures inflation at the consumer level. The headline number came in at 3.2% and the core rate came in at 3.8%. Both were higher than what markets and the bond market was expecting. Then on Thursday, we received February's Producer Price Index, or PPI report, which measures inflation at the producer level or wholesale level. This also came in hotter than what the markets were expecting. The headline PPI number was 1.6%, which is a pretty low range, but the jump from January's 1% to February's 1.6% was a significant increase, and traders and the bond markets did not like it. One of the main components within both reports that pushed up these numbers was gas prices, or the cost of oil. Oil prices are above $81 a barrel, according to WTI. This is an increase of about $10 since early January. And as you know, the cost of oil really trickles through to every part of the economy and what consumers pay. Next week is Fed's week. This is a big potential market mover. The Federal Reserve will conduct their regularly scheduled Federal Open Market Committee meeting. The meeting will conclude on Wednesday, March 20th, with Fed President Jerome Powell giving his monetary policy statement. The markets are not expecting any rate cuts at this meeting, but all ears will be listening attentively for any signs as to when they will make their first rate cut. The futures market is pricing in a 64% chance that they will cut rates at the June meeting. Other important talking points to listen for will be the statement of economic projections, which will include the Fed's famous Fed dot plot chart. Here's an example of December 2023 chart. This chart shows Fed members' projections for where they think the Fed funds rate should be over the next couple of years. So that's important. Many people will be watching for this. They will also update their unemployment projections, and this could potentially help mortgage rates. Higher unemployment will be good for mortgage rates, as this would indicate a slowdown in the economy, which is viewed as disinflationary. That would be good for rates. Lastly, there might be mention of how the Fed will move forward with their quantitative tightening program. QT hasn't really been talked about all that much, but may be a very important piece of the puzzle for mortgage rates in the future. I'll talk to you guys more about quantitative tightening in a future video so that we know exactly what to expect moving forward. Well, I hope you liked this video, and if you did, hit the like button, and if you haven't already subscribed to my channel, please hit the subscribe button as well. As always, let's get better, let's close more deals, and until the next video, I'll see ya.